Today, I'll be breaking down McDonald's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. McDonald's revenue growth has been a bit of a roller coaster. From 2014 to 2019, revenue declined by 30%, primarily due to a strategic shift towards franchising. By 2023, McDonald's had transitioned from 6,714 company-operated restaurants and 29,544 franchised ones in 2014 to just 2,142 company-operated and 39,680 franchised restaurants. Franchising allowed McDonald's to benefit from stable and predictable revenue streams through franchise fees and royalties, without the high operational costs of running company-owned restaurants. Franchisees bring local market expertise and are highly motivated to maximize their restaurant's performance. This model also enabled rapid expansion and scalability, as franchisees invest in the brand, spreading the financial risk. Additionally, McDonald's faced intense competition from other fast food chains and had to continuously adapt to evolving consumer preferences towards healthier and more diverse food options. Being a global entity, revenue was also negatively impacted by currency fluctuations, especially the strengthening of the US dollar against other currencies, which reduced reported revenue from international markets. To turn things around post-2019, besides the shift towards franchising, McDonald's implemented the Accelerating the Arches strategy, focusing on enhancing customer experience, menu innovation, and digital transformation. This included expanding digital capabilities like mobile app ordering, delivery services, and loyalty programs, which significantly boosted sales. These strategic measures resulted in a 34% revenue growth since 2019, marking a successful turnaround. Despite the significant decline until 2019, McDonald's has managed to almost recover to 2014 revenue levels, reporting $27.4 billion in 2014 and $25.8 billion over the last 12 months. This results in an annual average growth rate of -0.6%. Despite the revenue decrease over the past decade, things look different when we look into McDonald's net income. Net income showed significant growth, showing an annual growth rate of 6.6% and totaling an 88.7% growth over the decade. Such as net income, McDonald's earnings per share have increased significantly over the past decade. However, the earnings per share average annual growth rate of 9.3% is much higher than the net income's growth rate of 6.6%. This is because McDonald's has aggressively repurchased shares, reducing the number of outstanding shares and thereby amplifying the growth in earnings per share beyond the net income growth. Concluding the first dimension, McDonald's free cash flow has grown, though with some fluctuations over the past decade. The shift to a heavily franchised business model has reduced capital expenditure requirements, improving free cash flow generation. Now, let's shift gears to profitability dimension. The gross margin improved significantly, mainly due to the higher margin franchising business. It increased from 38.1% in 2014 to 57% over the last 12 months, an outstanding improvement. The operating margin also saw a substantial increase from 29% in 2014 to 47.3% over the last 12 months. The free cash flow margin also showed consistent growth, increasing from 24.1% in 2014 to 38.1% in the last 12 months. Lastly, the return on invested capital, although the current ROIC stands at 22.5%, which is slightly lower than the 25% recorded a decade ago, it still indicates a robust profitability. Moving on to the solvency dimension. The quick ratio has been deteriorating, recently dropping below the optimal level of 1. It decreased from 1.48 in 2014 to 1.16 in 2023, with the trailing 12 months at 0.82. The debt-to-equity ratio turned negative from 2016 onwards because McDonald's equity became negative. This shift resulted from substantial stock buybacks, which reduced the company's equity. When a company buys back its shares, the cost of the repurchased shares is deducted from shareholders' equity and recorded in the treasury stock account, a contra-equity account. This reduces total equity but is not considered an asset. Consequently, stock buybacks affect several financial ratios such as earnings per share, return on equity, or debt-to-equity ratio. Lastly, the debt-to-free cash flow ratio has significantly increased, indicating that McDonald's now takes more time to pay off its debt using its annual cash flows. It increased from paying off all the debt within 2.27 years in 2014 to 5.18 years today. This change is due to the increase in McDonald's debt from approximately $15 billion in 2014 to $50.8 billion today. Ideally, businesses should aim to keep this ratio below 5. Now the important fourth dimension, valuation. The EV to sales ratio for McDonald's has increased significantly over the past decade, peaking at 10.9x in 2020 and settling at 9.1x today. This is substantially higher than the 3.8x ratio recorded in 2014. This rise reflects the higher profitability McDonald's has achieved and the successful business turnaround the company has undergone. The strategic shift towards franchising, enhanced digital and delivery services, and continuous menu innovation have all contributed to this improved financial performance and investor confidence. The price-to-free cash flow multiple has also increased, currently at 18.6x compared to 14x in 2014. However, this increase is less pronounced than the rise in the EV to sales multiple. Additionally, the current price-to-free cash flow multiple is actually below the 10-year average of 20.8x, indicating a relatively more moderate valuation in this metric. This trend makes sense given that McDonald's revenue has remained relatively flat over the past decade, while free cash flow has increased by nearly 50% during the same period. The most favorable valuation multiple is the price-to-earnings ratio. The current PE multiple of 20.3x closely aligns with the 19.4x seen in 2014. In the remaining years, the PE ratio has not been this low. Which also makes sense, the higher growth was seen in McDonald's net income. Net income grew a total of 88.7% whilst free cash flow only grew nearly 50%. Now the fifth and last dimension, the shareholders' return. McDonald's dividends have exhibited robust growth, almost doubling over the past decade. They increased from $3.28 per share in 2014 to $6.38 today. Dividend yield has remained stable over the recent years, but we haven't seen a yield so high since 2016 when it ended the year with a 3% yield. Now on to one of the most important metrics. McDonald's shares outstanding have significantly decreased over the past decade. Starting from 986.3 million shares in 2014, the number of shares decreased to 729.9 million today. This represents a 10-year annual growth rate of -3%. Just look at the magnitude of this. McDonald's bought back more than 1/4 of the shares outstanding over this past decade. That's remarkable. However, we have to note that the magnitude of these buybacks have been decreasing in recent years. The payout ratio has remained relatively stable, decreasing slightly from 48.6% in 2014 to 47.1% over the last 12 months, indicating that the dividends are more than secure. More secure will be your financial situation after you subscribe to the Dude's YouTube channel and hit the like button. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is a great 3.4. Now let's move on to McDonald's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute McDonald's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices McDonald's stock fair value at $343, which is 37.3% above the current stock price, indicating that McDonald's is undervalued. The bull case prices McDonald's stock at $407, which indicates a 62.7% undervaluation. Finally, the bear case prices McDonald's stock at $236, which indicates a 5.7% overvaluation. In summary, McDonald's earns a great 5D rating of 3.4, with a weighted average price target of $334, implying a 33.8% undervaluation. McDonald's is a globally recognized brand. Over the past decade, McDonald's has taken significant steps in improving net income, earnings per share, and free cash flow, alongside achieving higher margins. The company has also shown a strong commitment to shareholder returns through increased dividends and substantial share buybacks. One of the major changes has been McDonald's shift to a franchise-focused model. This shift has been advantageous, providing increased profitability, capital expenditure savings, operational efficiencies, and scalability. Looking ahead, McDonald's has several growth drivers. The continued investment in digital platforms and delivery services aims to enhance customer experience and operational efficiency. Ongoing menu innovation is set to meet changing consumer preferences and attract a broader customer base. McDonald's is also accelerating its global expansion, targeting 50,000 locations by 2027, driving substantial revenue growth. Additionally, leveraging AI and cloud technologies will streamline operations, improve customer interactions, and boost service efficiency. However, McDonald's also faces significant risks. Market saturation in established markets could limit growth opportunities, requiring continuous innovation to enhance customer experience. Economic and regulatory challenges, especially related to health and environmental standards, could impact operations and profitability. The fast food industry remains highly competitive, with both new entrants and existing players continuously innovating. McDonald's global operations also make it vulnerable to supply chain disruptions, affecting inventory management and service delivery. Finally, the shift towards healthier and more diverse food options requires constant menu adaptation. Failure to align with these preferences could impact revenue growth. Given all these insights, I plan to take a closer look into McDonald's business before making an investment decision. That's why my final verdict is, next round, Analysis 2.0. Don't forget to subscribe to my channel and stay tuned for the next analyses.